Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is self-constructed assets. A company might decide to construct an asset for its own use rather than buy an existing one. Identifying the cost is difficult because there is no external transaction to establish an exchange price. And sometimes we have no market value. And we have two critical issues, one more critical than the other one. Determine the amount of indirect manufacturing costs, the overhead, to be allocated to the construction, and deciding on the proper treatment of interest, actual or implicit, incurring during construction. This is the hardest part. So, overhead allocation. How do we do that? Treatment of manufacturing overhead costs and its allocation, inclusion of only the incremental overhead cost and full cost approach, just like inventory for manufacturing companies. So, no hard topic here. However, interest capitalization, capitalized and then allocated as depreciation. So, we need to capitalize interest. However, usually we cannot match the loans and the construction. We need to do another approach here. How do we do that? Qualifying assets. Assets that are constructed for a company's own use, as well as assets constructed as discrete projects for sale or lease. So we can capitalize interest here. Only interest incurred during the construction period is eligible for capitalization. It doesn't matter if we will pay it later. Only the interest incurred during construction period is capitalized. Period of capitalization begins when construction begins and the first expenditure is made, as long as interest costs are actually being occurred. Average accumulated expenditure approximates the average debit necessary for construction. So, what do we have here? Whoops. Let's go to our Excel file, and all our Excel files, they are free, and the link to download it is in our video description. What do we have here? And by the way, subscribe our channel. You will be the first one to know when a new video arrives. And like our Facebook page, Accounting Hub by Dr. Scarpin. So what do we have here? January 1st, Scarpin Corporation began construction of a building. The building was completed on June 30th, 2022, 18 months later. Expenditure on the project, mainly paid payment to subcontractor, were as follows. So three huge payments on 2021, two payments on 2022. So let's find the interest to be capitalized during 2021. 2022 would be the same. So on January 1st, 2021, the company obtained the following loans and interest-bearing notes. Construction loans, so a loan specifically for construction, and two interest-bearing notes. These are the amounts and interest rates. The loan and notes were outstanding during the entire construction period. What do we need here? First, weight average accumulated expenditure. So we have two scenarios here. The first scenario, that is not our scenario here. Expenditure incurred are fairly even throughout the period. So the average would be the total divided by 2. So half of them on the first semester, half of them on the second semester. So the average is uh, the total divided by 2. So it would be 960. The second scenario, expended are not incurred evenly throughout the period. We have three payments only. How do we do that? Three payments here, the same. And portion of the year. How do we find it? The first, January 1st. So we have 12 months of this payment. So 12 divided by 12. The second one, March 31st. So here we have this payment here was uh, expanded in March. So how many portion of the year do we have? April, May, June, July, August, September, October, November, December. 9 months. So 9 divided by 12. So 3 quarters of a year. The last one, September 30th. So we have October, November, December. So 3 months in 12. 1 quarter of the year. And the time wage expenditure will be actual expenditure times portion of year. So 640, 360, and 200. So $1.2 million. So this is the average accumulated expenditure for 2021. Step 2, amount of interest to be capitalized. We have two methods here. The first one is specific interest method. So expenditures times. We have a specific loan for construction. So we get the same interest rate here. So the interest rate for the construction loan. And then the interest capitalized is 1.2 times 6%. We will see the second method later, okay? And how do we know if we will be using this number? We go to step 3. We calculate the interest with actual interest incurred. So here we find all of the interest expense. Interest, so loans here, interest expenses, and actual interest. How much would be our interest capitalized? We compare annual interest with calculated interest. And or total interest is better. We grab the lowest number. So we compare 672 with 72. 72 is the lowest one. We would, but wow, that is too much difference here. Let's consider that I don't need a lot of money here. My construction loan is only $500,000. Here is only 600, and here 50,000. Our total interest here would be uh whoa, let's decrease a little bit. 60,000. So our total interest would be 38. So our calculated interest would also be to 38. So we would be using 38 instead of 72. Okay? But we don't have it here. Yes, that is how much we actually have. And okay, let's take the weighted average later, okay? So accumulated expenditure, how much would be the total cost of the total cost here, 190, plus interest capitalized, that is the calculated interest, 72. So the asset, the accumulated expenditure, so this is the asset at December 31st would be $1,992,000. This is the specific interest method. And how much would be with the weighted average method here? How do we find this construction loan? Why is 6%, 7% instead of 6? We grab annual interest here divided by total loans. Or let's make it pretty. Total interest divided by total loan. So we are working with a weighted average interest rate. So if we compare not only the construction loan, but all of our loans and notes, our weighted average interest rate would be, so not construction loan here, weighted average would be 7%. And then the interest capitalized would be 84. And then cost of the building would be the same. And the interest, the lowest between 84 and total interest. So the minimum between 84 and total interest, 84. And the total would be the sum. So it would be 2 million, a little bit more than $2 million. Okay, guys, so that's it. Not so easy, a lot of steps here. So watch this video as many times you want. And the most used one is the specific interest method. However, the weighted average method is also allowed both on US GAAP and IFRS. Okay, guys, so thank you so much. If you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.